Chapter 26. How many stocks you must own? By now, you have read the basics of stock market investment and the rules or guidelines that help you to create successful ventures fetching high returns. But after having read so much about how to invest, the fundamental question remains the same, which is how many stocks should I own to have a significant investment portfolio? If you too had this question resonating on your mind all this while, then don't worry, as you are not alone in finding an answer to this. In earlier days, the investment in stocks were guided by modern management theory. As per the theory, the investors are taught to never lay all the eggs in the one basket. Rather, they should look at diversifying their portfolio to diversify the risk. But nowadays, a concentrated investment is considered a better bet than a diversified one. Today, it is believed that an investor must lay all his eggs in one basket and watch that basket grow. This concept is believed and followed by all investment gurus worldwide. It is so because the idea of value investing has replaced the concept of diversified investment, which prevailed earlier. Now it is believed that any investment that you make should be well researched and should be based on the valuation of the company. So, if the stocks are picked with this approach, it is evident that only a few stocks will fit in the specifications, and hence the portfolio will be concentrated. Warren Buffett emphasizes that you must measure every investment wisely and invest with an attitude as if it is the only investment you will ever make. And by following this practice, you would have fewer but well thought over, well researched investment portfolio. But the question remains the same, which is how many stocks should you opt for in the beginning? Here is what the famous legend suggests on buying stocks. The best way to get into investment is to buy stocks within your circle of competence. You must pick one or two companies that you think are in a business that you understand well, and try to delve deeper into knowing more about those companies and digging into details that we have discussed in earlier chapters. Keep repeating the same process with other securities. Slowly, you keep adding to your portfolio to bring up the number of investments. So, it is good to have a well thought over collection of stocks in your portfolio, but coming to a number will be difficult. Most professional investors stick to keeping 15 to 20 stocks in their investment kitty as a thumb rule. Ben Graham indicates that any number of shares between 10 and 30 is good enough to have a stable, risk-averse portfolio, whereas Warren Buffett advised restricting your collection to just 5 to 10 stocks. But if you still want to know what should be the ideal number of stocks to hold in a portfolio, then there is no consensus on this. As per my advice, when you start as an investor, you will tend to make mistake. So it is the time to diversify your portfolio rather than betting on one or two stocks. Of course, if you are a young individual with no dependents on you, then you can buy more stocks depending on your disposable income. There are two kinds of risk that an investor is exposed to over time. One is called the unsystematic risk, which is associated with the company or industry you have invested in, and the other is the systematic risk, which indicates the risk of the entire stock market crash or recession. Having more number of stocks in a portfolio guards you against the unsystematic risk to a greater extent. And by being a serious long-term investor, you anyway guard against the systematic risk of investment. Good stocks defy all odds. The stocks of companies with efficient management defy all odds and tend to perform well in the long run. When there was a stock market crash in India between 1992 and 2003, the Sensex hit an all-time low. But stocks of good companies like Infosys still moves up a few thousand times. Beside other stocks of some promising companies in the technology, pharmaceuticals, and FMCG sectors also moved up considerably during this crash. Thus, it shows that good stocks end up delivering good results during the negative years too, provided you hold on to them for a longer time. Stocks or mutual funds? Which is a better investment bet? The biggest myth that has been around for decades is that mutual fund investors have a safer ride as compared to individual investors. But is this true? Let's dig deeper to understand who is at an advantage when it comes to stock investment. For decades, mutual fund investment have been believed to be a safe bet in stock investment. Yet, individual investments are considered better than mutual fund investment. These days, individual investments are preferred due to the following reasons. An individual investor always has a focused approach as compared to a mutual fund investor whose interest is always diversified. An individual investor has the freedom to act upon his interest, whereas the mutual fund investor diversifies to protect their stock asset from fluctuation. The individual investor can invest immediately as per wish, but a mutual fund investor have to balance their portfolio with low priced or index stocks. The mutual fund investor needs to keep the option open for the liquidation of stocks during emergencies, unlike individual investors. So the freedom of picking up the stocks and selling them at will lies only with an individual investor. The mutual fund investor gets too busy balancing the stocks to protect them against the high risk of loss. Hence, it is better to be an individual investor, as that would mean that you are a free trader. But this journey of becoming an excellent individual investor progresses slowly. Hopefully, this book helps you chart your course as a successful individual investor soon. Can individual investor outperform the mutual fund investors? Yes, individual investors can outperform the mutual fund investor at times due to the following reasons. Number 1, risk taking ability. The mutual fund investor cannot take the risk as they are accountable for someone else's money, so they have to play safe. On the other hand, individual investors can take as much risk as they want because they are investing their own money. For example, suppose a mutual fund investor invested his client's money to buy a few stocks of Infosys Limited. But due to market fluctuation, the Infosys stock price drops, leading to a loss. In this case, the mutual fund investor is usually not blamed for the losses, as Infosys is considered to be one of the safest bets for investment. And any investor would blindly invest money in big names like Infosys. On the other hand, if the same mutual fund investor would have invested in a funds like V2 Retail and suppose its price dropped, then his investment skills and understanding would be questioned as V2 is an unpopular stock. So the mutual fund managers are forced to refrain from taking a risk to protect their image and to keep their job secure. Number 2, SEBI regulation. A mutual fund company is bound by the SEBI regulation, unlike an individual investor. As per the SEBI guideline, a mutual fund company has to abide by the following guidelines. Number 1, a mutual fund investor cannot invest more than 10% in one stock, whereas an individual investor has 100% freedom of investment. Number 2, a large cap fund cannot invest in a small company, whereas an individual investor can invest anywhere at any time as per wish. Number 3, a mutual fund has serious liquidity concern to liquidate the generated portfolio. On the contrary, an individual investor can liquidate his stock as freely as required. Number 4, a mutual fund manager cannot choose when to sell the stock. He has to sell the stocks when the redemption pressure crops in. But an individual investor faces no such challenge. The same has been explained with an example at the end of this chapter. Number 5. A mutual fund company is not able to invest because of its huge financial investment corpus and due to the SEBI disclosure requirement. But an individual investor is not bound by any such regulation. Sounds complicated, right? Let's understand this with an example. Suppose an XYZ company has released 1000 shares at rupees 100 each. The mutual fund company sees potential in XYZ company and wants to purchase a vast number of its shares. Also, the mutual fund company is aware that XYZ will release the next 1000 shares later. Suppose the mutual fund company brought all 1000 shares at 100 rupees. So as per the SEBI guideline, any investment of more than 10% needs to be disclosed publicly. Thus the next day's newspaper will reveal that so and so mutual fund company has bought 1000 XYZ shares. And as soon as this news is out, the price of the stocks of the XYZ company will increase as the demand has increased. After this, XYZ releases another 1000 shares at a hiked price of say rupees 500. Now the mutual fund company will be reluctant to buy a new set of 1000 stock as the prices have increased. So this is how a mutual fund company is not able to buy enough quantity of stocks because of its vast corpus and SEBI disclosure requirement. Let me share with you one of the personal experience depicting how individual investment outperform most of the time. A couple of years back, one of my family friend sought advice from me on stock investment. I have researched a company that appeared to have a promising future. So I bought a few shares of it and advised my friend to buy some. The shares were priced at rupees 500 at the time we both bought them. After a few weeks, the share price dropped to rupees 400 and my friend started worrying. But since I had faith in the company, I bought a few more shares at a reduced price and advised my friend to buy some more. My friend reluctantly purchased a few more shares on my advice. After some time, the price dropped to rupees 300. He again sought my opinion on this investment. I insisted on holding those shares and also advised to buy more, as I did. He still bought some more shares, but very hesitantly. Finally, the price dropped to rupees 200 a few days later. My investor friend lost belief in me and sold off all the shares at a massive loss of 60%. But I continued to buy more shares of that company as I know the prices would bounce back soon. Now my average price per share has become rupees 210. In 3 years, the stock price increased to rupees 700 and I made 3 times my initial investment value. So as an individual investor, I could take the risk with my money and acted as per my wish and thus ended up making good money. But as an advisor, my hands were tied and the funds had to be liquidated against my will when the redemption pressure cropped in. So this is how an individual investor outperforms the mutual fund investor in the stock investment business.